Hello, this is Patrick. Welcome to Chart Built Wealth, profitable investing with technical analysis. Earlier today, I posted a update on China, which has been a great holding for us. Done very, very well. Didn't have to chase it the last couple of days like the rest of the YouTube investment community. But I wanted to go over my outstanding holdings, my bullish holdings right now. And I'm going to go through in order after I do a short take on the overall market. So let's get into it. So this is a long-term chart of the S&P 500. I am not making a call here on the S&P, but this is a long-term chart going all the way back to 1997. And what I'm trying to highlight here is that long-term, I'm bearish on the U.S. stock market. It doesn't mean I don't own stocks. It doesn't mean, there's not things that I like. But in the back of my mind, I see these negative divergences that we currently have, and it makes me wary to go all in. So here we've gone from 97 to 2000. You can see the negative divergence as we hit all these higher highs. We had lower highs on our RSI flashing a caution sign, beware a change of trend is coming. And sure enough, boom, see this same thing, a much smaller negative divergence in 2007. And then you can see starting in 2018, we've had the biggest negative divergence that I've ever seen. And I've been doing this a long, long time. I don't know, 30 some years. But I just wanted to point that out. So long term, I'm bearish on this market. At some point, this is going to matter. Short term, I've been bullish, but I did try to get bearish here recently. We had what's called a moving average rainbow convergence, where we had a cluster of moving averages coming up. Like here, prices were not able to break down. It promised us a new low, and that's what we got. We had the same thing here recently in early September. So I went bearish here. But prices were able to break through that cluster of moving averages. So it negated that. So I took about a 1.5% loss, I think, on the short call, and that was posted on my YouTube channel. So again, just I'll go any direction as long as I can make money. I'm not overly bullish or bearish. I just look for patterns. I look for things that are going to make me money and make you money. So let's move on to, in order of my outstanding positions, what I like. I really like the REIT sector. The REIT sector is somewhat defensive, but also has been a star performer, utilities and REITs since for the third quarter, July through the end of September. I was long utilities when nobody liked utilities. I got us out at a very high level, made a good amount of money. I want to say 25%. I was long XLU and long Southern companies. Both of those did extremely well. I'm now neutral on those. They reached my price projection based on my patterns that I had for them. You can see the REIT sector hasn't gotten there yet. So we're looking at IYR. We're looking, these have nice yields. We're looking at 112 on the upside based on this inverse head and shoulders pattern here. Here's the left shoulder, here's the head, here's the right shoulder, here's the neckline. So I'm not telling you to jump all in with this because there's nowhere really to put a stop here. This thing has gone vertical, but here's where I recommended it. So while I like it, and if I had to buy U.S. equities right now, I would look at the REIT sector. When I look at the REIT sector, I like American Homes for Rent. I have no idea what their financial position is. I like their chart. And this is something that I recommended back in May or June. And you can see, again, we have that inverse head and shoulders pattern. This right shoulder doesn't have the same symmetry as the left shoulder, but I actually am using my price projection based on a ascending triangle. Here's the resistance line, here's the support line. And when it was trading in here, I recommended it, and it broke out. This was the last REIT that I recommended. The other was NNN was a symbol, National Corp or something, which has also gone vertical. This was the last one to break out, so you had a good chance to add. It broke out, and whenever things are up, I'm selling, I'm selling, I'm selling. Part of my position, I do that every day that something's up. I'll sell a few shares, I'll touch it, I'll touch it, I'll touch it. When it's down, I buy. When it's up, I sell. And so, I probably brought this down to somewhat of a minimum. And now, this past week, I've been nibbling at it. So again, it's not overly attractive that you don't have a stop because it's gone vertical until you get down to 35. So that's a lot of risk. Let's just call it $3. That's almost 10%. But the upside is 46. So the reward to risk is just about 3 to 1. And so I like this. And again, I'm buying, adding back to my position on any down days. The next buy recommendation that I still like, and this is in order of what I currently like, and that's Marathon Oil. As the followers of mine know that I did try to go bullish on crude oil and got stopped out. Um, right? I still think that crude oil is going to do well eventually, but I'm not ready to jump on that bandwagon quite yet. I'm going to share with you why. If crude oil doesn't go up, energy stocks will not do well. So it's critical that crude oil goes up. However, our big symmetrical triangle is still intact. It actually looks like it's tracing out a smaller triangle here. Here's the resistance line. Here's the support line. So I'm going to stay with this, and the upside is enormous. I mean, we're looking at a $50 price projection, which is, over 60% potential upside. And the reason why I'm showing this as after REITs as my next best alternative is a reward to risk is, I don't know, 10 to 1, maybe 15 to 1. But my stop here is at 25. Not only because of my chart here, but also on the point and figure chart. It will break its bullish trend line if it breaks 25. So this is the place I was adding last week, even though I'm not overly bullish on crude. Again, I'm just nibbling at this. The week before I was selling, now I'm kind of buying. I still don't have as big of a position as I want because crude oil is so iffy. And this is why it's so iffy. If you look at this is the commitment of traders report. It's issued by the futures industry, and the commercials are the big boys. They're the ones in the business. They're the BP Amicos. They're the Chevrons of the world, and they're hedging their oil by buying futures contracts and stuff. And you can see right now uh, they are at an all-time, well, not an all-time, but going back to 2015, they're at probably their most bullish position. So that tells me that crude oil should rally from here, but you can see that it doesn't, sometimes it takes time for that to happen. And so, this was a great call here. This was a good call here for a while. And you can see, though, how rapidly they change their position. So right now, it's suggesting that oil's going to go higher. But when I look at, so anyway, again, I just don't have the chart of crude oil telling me to jump back in. There was actually a bearish engulfing pattern last week. So I'm a little tentative on that. But when I look at Marathon Oil, it's telling me that the pattern is still intact. The reward to risk is really, really favorable. And so out of all the things I'm following right now, that looks the best. The next on the list would be treasuries, fixed income. Again, I got bullish back here in June when nobody wanted to buy fixed income. Everybody said rates were going higher, they were going higher, they were going higher. Sentiment was very, very bearish on bonds because as bond prices go down, yields go up. So people thought rates were going up and they were bearish on fixed income. Well, guess what? They were wrong, like they're usually wrong. Consensus is normally wrong. You know, the boat gets too heavy on one side and it tips. So this pattern, again, we got an inverse head and shoulders, pretty big, 1, 2 years in the making. You measure from the bottom of the head to the neckline and project that up, you get 115. That's a really good upside at 100. We're in the money in a good way. But again, here we don't have a good place to put a stop. Where do I put a stop? I'll be looking for a stop before it gets all the way down here. Trust me, if prices go down. So again, the pattern says there's a lot more upside. The reward to risk isn't as attractive because I don't have a good place to put my stop. You know, maybe I should raise it up here. But this wasn't a significant bottom like this was. So anyway, treasuries and fixed income would be third on my list behind REITs and Marathon Oil. And here you got your point and figure chart. You got a new bullish trend line, which is great. Look at how long it was in a bearish trend going all the way back to 2020. What I don't like about this chart, it's not showing as much upside. The point figure is not showing as much upside as my chart did. It's only showing 102, which basically says it got to its price projection. So anyway, I still like this third. The chart here is the pattern looks great. It's telling us that that treasuries and fixed income are going higher. So that's third on my list. China, which I talked about in the video today. If you didn't listen to that and you're interested in China, I would definitely listen to that. I got bullish on China back in March when prices were down around here. And you can listen to the whole call. This pattern, this inverse head and shoulders patterns, uh, almost 2 years in the making, similar to the Treasury inverse head and shoulders. This is suggesting a $39 price projection. Reward to risk really favorable. Our stop down here, but after something being up 18.5% in a week, I think people are getting a little overzealous. Look at this volume bar as 18 or 19 YouTube investment channels jumped on this bandwagon Thursday and Friday after it's up 18%, not very bright. So what did I do on Friday? I sold some. Anything that's up 18% in a week, I want to put that money in the bank. So I was selling some of my shares, maybe 5%, maybe 10% of my holdings. We get a downtick over the next day or two, I'd be adding to that. So that's China. Again, listen to the video if you want more color on this. I also talk about Alibaba, which I went bullish on last Sunday, and it was up over 20% last week. Next on the list would be, can you see that with my head there? Is gold miners. This was something that I bought back in, I want to say it was like May. You could call this a symmetrical triangle, resistance, support, or you could call it an inverse head and shoulders, which I'm calling it. So this tells you that it's got a long way to go up to 50. However, as prices have been hitting higher highs, we're getting a negative divergence on our RSI. So that's making me think that there's some sort of a pullback. And when I look at sentiment and you look at the commercials, the big boys, the Newmont mining people and that, they're really hedging their gold. They are at a really high net short position, thinking that it's going to go down. If gold goes down, gold miners are not going up; they're going down too. So there's a lot of commodities I like. Copper, which I was bullish on early in the year, made a lot of money for our viewers. Was smart enough to get out. It crashed. Now it's looking bullish again, but it's overdone. And if you look at the commercials, the big boys, they're really long the dollar. If the dollar rallies from here, it's going to be hard for commodities to go up. They have an inverse relationship. So I just wanted to point that out.